as head of India equities research at Morgan Stanley. So, Ridham, the question that I want to ask you is that the general belief is from here on, the mid-cap should do better, the market breadth should improve, and domestic economy stocks should start to outperform. Is that a simplistic sort of assumption, or do you agree with that view?
Very clearly, yesterday afternoon, the market told us they are done with elections, and the nifty reaction in the afternoon really puzzled me. And I always wonder whether we have any ability to call markets. I mean, imagine if a few days ago, somebody had told you for certainty that BJP was going to go 300 plus and NDA was 350. And what do you think the market is going to do? I don't think anybody would have forecasted what happened yesterday. So much for our ability to call markets. The question that you ask, yeah, I kind of concur with that. I don't think it's actually directly related to the election outcome. I think the economy has gone through this soft spot for the past 4 or 5 months, which is largely to do with the tightness in liquidity and the problem that the non-banks have faced. And to a great extent, that liquidity tightness is already ebbing. I think at its peak, it was about $20 billion. It's now circa 5. I won't be surprised if the RBI moves to neutral territory on liquidity, which it hasn't for several months. I mean, you would go all the way back to the demon period when we had surplus liquidity. And of course, the reasons for that were very specific to that event. So yeah, if the RBI does do that, then I think we'll have a much stronger economy in the second half. Now, if this is backed by some policy actions, and there are a slew of things that the incoming administration can do, then I think the conviction that we are entering into a stronger growth environment will increase. So my bet would be to buy domestic cyclicals. I particularly like the auto stocks, as we had discussed on polling day in Mumbai. I think they are pricing in a significant slowdown and maybe even negative growth in F20. And I feel that at some point in time in the next 2 or 3 months, we should see a discernible turn in auto demand. I don't think underlying consumption is as badly hit as the headline numbers are showing. It's largely to do with a mismatch in production and the slowdown in consumption that we saw for 2 or 3 months, and then the inventory built up as a consequence. So I think we'll see that this is behind us pretty soon. Okay,
Ridham, what is this slew of administrative measures you're expecting?
Oh, you mean from the government?
Yes. You just alluded to it.
Yeah, so no, actually it's not necessarily only from the government. I think there are a sequence of things that are about to happen. So let's count them. The first thing is, of course, the RBI will meet for its rate decision. I think the likelihood is that they'll cut rate again. The second is that there's this ongoing liquidity infusion, as I alluded to, and I think we may be heading into neutral territory, which, by the way, do not underestimate that. That's huge for the banking sector. It changes the rate transmission in the system. The rate transmission is severely affected by the liquidity deficit. So suddenly you get rates falling, which should augur well for demand, which should augur well for the banks. The third is, let's not forget, the Bimal Jalan committee is going to decide on the RBI reserves. And if for a moment we assume that they are going to opine that the RBI has excess reserves, suddenly you have a bullet payment that becomes due to the government. Now, the government can do a lot with that. It can pay down debt. It can recap the PSU banks. And if it chose the latter, that's another big boost to the economy and to credit growth and to the banking sector. Because what the PSU banks today suffer from is lack of capital, not lack of deposits. So they are running LDRs, that is the loan deposit ratios, which are well below the sector average. And the reason why they cannot lend is because they don't have enough capital. Then, of course, we'll head into the union budget, and a lot could happen in the union budget, which includes, in my view, the potential of a tax cut for corporate India. Remember, Finance Minister Arun Jaitley had promised that 2 years ago, and there has to be some follow-up to that promise either in this budget or the next one. So I don't think we should rule it out in this budget. I know there are fiscal constraints, but we could well get a little bit of fiscal slippage. This could be a slightly differently managed macro environment from, say, 2014, because India actually has much better macro stability today. We have benign inflation, we have a current account deficit that's pretty okay, and we have a fiscal deficit that's significantly lower than it was over 5 years ago. So a little bit of fiscal slippage may not be such a bad thing. So quite a few things lined up between now and early July for us to deal with.
Okay. Well, as of now, the indications are that around the 10th to 15th of July is when there will be the budget announcement. Let's talk a little bit about global cues, because we haven't done that for a while. We were just so besotted with the election outcome. But now that it's out of the way, a lot of Wall Street participants believe that the trade war is here to stay and could get worse. What do you think the implications could be on global flows, especially into EMs like India?
So I think India is a little bit idiosyncratic. If you look at the correlations between India and emerging markets, they're actually at multi-year lows, and appropriately so, because amongst all the large emerging markets, India is the least affected by the ongoing US-China trade tension. So to an extent, we are not affected on a relative basis, but of course, on an absolute basis, if things get worse, and if this morphs into a full-blown trade war, then there will be impact on global GDP growth, and then there will be impact on India as well. So we cannot remain unscathed.
Ridham, before I get to that 45,000 target of yours, just a word more on financials. You spoke at length about liquidity, and I suspect it's going to return. Usually June, July, August, currency with the public reduces. It goes back to the banking system anyways, and there is a 69,000 crore unspent money of government, which will start getting spent when the ministers are appointed. So that is taken. But is that enough to resolve the debt market NBFC mutual fund issue? Or do you suspect that it will need something extraordinary, a stressed asset fund, or I don't know what, but something of the US 64 IDBI variety?
No, see, Lata, I will not be so alarmist. And we have discussed this issue over the past few months. I think that there are idiosyncratic issues, and clearly there are some. And, there are some loans that have become stressed. But if you see, a lot of those loans are backed by assets where there are deals in the pipeline. And I suspect that those deals were getting delayed because, the other side of the deals, the buyers were probably waiting for the elections to be out of the way, just in case India produced a very fragmented result, which would have then changed the valuations of those deals. But I think with the elections out of the way, I wouldn't be surprised if some of these deals hit fruition pretty quickly, because the underlying assets that are up for sale are not bad. They're not really terrible assets. What we have is a situation where certain promoters have over-levered their balance sheets and invested money into other businesses where there is a little bit of stress. So if these deals happen in the next 2 or 3 months, I think a large part of this problem will ebb. So I don't see a systemic risk out of the NBFCs, which certain quarters of the market believe, this debate will go on until the stress abates. I think it's more idiosyncratic and solvable. And therefore, in the context of, the market speculating, will there be a line of financing for the NBFCs and the RBI saying they don't see any need, I think this is where the push and pull comes from, which is the RBI still doesn't sense that there's a systemic problem that they need to open up a line. But there is obviously certain parts of the market that are feeling the pressure and they want to be bailed out. And that happens all the time. So my view is that we are in an idiosyncratic situation, and of course, on NBFCs per se, as we've discussed, I think as a aggregate, the sector needs to see a balance sheet shrinkage, greater capital, and more liquidity, and therefore slower growth. All good for the large banks. The banks will benefit out of this because they have lesser competition to deal with.
Ridham, there's one section of the market that believes that Prime Minister Modi, as he comes back into power, will focus on a few things. Of course, we discussed a couple of them, but one big area of focus could be infrastructure, a renewed emphasis on, roads, housing, waterway, etc., a revival of industrial growth. As a stock market investor, how do you capitalize on that?
So, Sonia, the manifesto of the BJP has a $1.4 trillion number, which is quite a large number. I would be a little bit more conservative. I think if public spending to GDP crosses 10% over the next 3 years, it will be a great outcome. But we know from the previous 5 years track record that this outgoing government has executed well on infrastructure, whether it's roads, whether it's metros at the state level, or it's the stuff that's happening on water and electricity. So I think it should be a fair expectation that this continues. The order books of industrial companies have been showing a tick up for several months now, and there's no reason to believe that that may not continue.
Ridham, my last question, what does this verdict mean for the flow picture domestically? I mean, FIIs, we all know that will now invest more, but is the market likely to go through a bit of a Goldilocks period where the DI liquidity will be strong and something which will keep us in good stead? We went through that period post demonetization where, despite a lot of FIIs selling, there was quite a bit of DI buying. Do you think we could see something similar going forward?
See, Anuj, we've been discussing this for 4 years. Let me emphasize this again. We are in a new era with respect to domestic saving in equities. There's a structural shift happening. It's a consequence of cumulative regulation over the past few years and a lot of other fundamental changes that have happened in the characteristics of this economy. I will not go into those details, but I think the bottom line here is we should get used to much higher flows.
45,000, which stocks or sectors will take us there?
Yeah, so I think I'm most constructive on financials, domestic cyclicals, which includes consumer cyclicals like autos and industrials. 45,000 is about a 15% upside, and I think it will be largely driven by an earnings recovery, not by a multiple expansion.
All right, Ridham, we actually have been hatching a plan to try and get you to talk stocks for the last 10-15 minutes, but we've been unsuccessful. We'll try again next time. Thanks so much for joining us on the show and speaking about the market and your expectations.